Trade war has begun. The question is, how low can the stock market go with this trading war? While we now into stages which we will see more retaliation by some of the countries which Trump has introduced those really high tariffs. And also we will see a certain level of a negotiation, countries trying to negotiate and therefore bringing some equilibrium, which is the most sensible thing to happen in this trade war. Now, what I want to explore in this video is how low can the stock market go, and also which one of those ASX growth stocks that we have been trading in the past, we have been covering this channel, which one of them are the cheapest? In fact, we're going to be taking our analysis to a whole new level, because BGS20 trading strategy is very effective when the market is in normal conditions. However, what is driving the markets now is panic. And with panic or overexcitement, it becomes very challenging to only use BGS trading strategy based on technical analysis, as market can fall like 5-6% that we have seen a couple of days ago. What we need to understand now is, where are the value opportunities? Why are the stock that has fallen the most and presenting strong value? In fact, I have benchmarked all those stocks that we have been trading. Obviously, they are not all of them into this list, just some of them. I took only the ones that are profitable, net profitable after tax, and also only the ones that have been increasing revenue year on year. And then we're going to see which one is the cheapest according to those three key metrics that we are using, and those are fundamental metrics used by analysts and hedge funds to deep look into each one of them. Let's have a look. Hi, my name is Elias and I'm Chief Analyst of BG Trading Australia. I wanted to highlight this is not a financial advice, just sharing with you how we apply BGS20 strategy and multidimensional trading approach to take advantage of potential opportunities that lead us to 20 to 40% profit or more within 1 to 3 months. I would like to invite you to subscribe this channel. I've seen that a lot of people watching those videos but not subscribing. Please subscribe and you'll receive some notification about the new videos. Also, I would like to invite you to become a member of our page, BG Trading, on Facebook as well, and also our Facebook community, buy, grow, and sell strategy for share traders. We post a lot of great quality content there, and we cover here. Also, I'm going to be using the content of an email that I sent to my members today. So if you wanted to receive this type of emails with information about the stock market and stocks and potential buying opportunities, just make sure you subscribe our mail list, which will be the link available at the comments. So a lot of great quality content going to be sent to you. So essentially what I did, I started using 3 different metrics to evaluate whether those stocks are expensive or cheap in comparison to each other. I benchmark them using those 3 metrics. The first one is enterprise value against revenue, value in the market in placing on each dollar of the revenue, which is a very commonly used metric for growth stocks. The the second metric that I use is enterprise value to net profit after tax, because a net profit after tax is one of the most important metrics, together with the earnings before tax. I really like using net profit after tax or net loss after tax to have a really good ground of the value of the company and whether the company is actually improving that year on year or quarter on quarter or every 6 months. And the last one is a PE ratio, which is commonly used. This is traditional but still powerful measure. So why are we using these metrics? Again, why the BGS20 strategy remains highly effective under normal conditions. When panic hits, that requires a whole new level of assessment. And the reason that does is because, and that comes down to answer one of the questions that I'm supposed to answer in this video: how low can those stocks in the market go? And the answer is very clear. We have absolutely no idea, because we are in an unknown territory. Last time, there was a few decades ago, which there was a similar trading war, and that led to a recession and depression. So that could be pretty ugly, but equally that could turn around the whole US economy. Most likely will, either to a positive outcome or to a negative outcome. The outcome we're looking here is in line to what I have covered in my last video, which was the theory that Donald Trump is using there to be able to get Fed cutting rates, so inducing to a recession, so Fed cut rates, and then obviously that will boost the economy later under this new protectionist trading model. But equally, that will also provide the US with a very low interest rate, which will allow Donald Trump to refinance short-term debt into a long-term debt at a very low interest rate. That's what I think it's going to happen if it's successful. Now, if that happens, that means we will have a recession, or things going to turn pretty badly, which means the stock market can fall further. However, if Fed point for a possible rate cut again, and we're talking about 1, 2, 3 times, next FOMC meeting is early May, so you have stay tuned for that. That means that most likely growthy stocks will do really well. Not from now maybe, but from the bottom of the market. And that's exactly what we want to be looking at. However, there are a lot of growth stocks now that are profitable companies, and not longer only growth stocks, but actually profitable companies with a positive outlook despite the rush in macroeconomic environment. And that is exactly the stocks that we are looking, and that stocks that we have been looking. They either have been falling quite substantially and presenting now very, very cheap in comparison to other stocks, or they are companies that could even benefit from this trade war. I'm not saying that's going to be the case with all those stocks, but we are trading a company that is most likely will be able to benefit from this trading war, and the stock is up 10% since we bought later last week on Friday by chance together with our VP members. Obviously, if you want to have access to that, you need to sign up as a VIP member. And equally, all those stocks we are analyzing today in this video, it doesn't mean they are immediately a buy opportunities. I'm just benchmarking them against each other to see which ones are the cheapest. So according to this rank, we come up with Bubs Australia as the cheapest with a PE ratio only 13 times. That for a growth stock, that is pretty cheap. And I can tell you this, if you ask me which one of those stocks are the safest to buy in terms of valuation, I would say Bubs Australia, based on those three metrics. We connected all those three metrics, and we came up with number one, Bubs Australia, as the cheapest of them all. Then followed by Cettire Limited, which is a stock that continues to grow revenue, obviously highly impacted by the tariffs, but now that most of the uncertainty regarding how much would that be impacted is on the table. I reckon Cettire Limited is now highly de-risked for that particular reason. In fact, I believe Cettire could bounce very, very strongly from recent lows, and we're going to analyze that on the chart in a few minutes. Then the third one comes EML Payments. EML is a stock that has been very strong relatively to the other stocks, and normally the ones that tend to hold best into those market crash are the ones that are going to be outperforming later on down the track. Then Kogan also, with a PE ratio only 19 times, it comes as a fourth position right there. Kogan is a domestic company. It's not directly being affected by Donald Trump's tariffs, but what we could see is if RBA start cutting rates further, that would directly benefit Kogan, as it is a domestic retailer. And as soon as RBA cut rates, that will boost economy and spending. And then in the fifth position here, only 27 times, we have Zip. And obviously, Zip is a stock that we really like. We have been trading many times. Last three trades, it fell on the stop loss, mostly because there was this sell-off on tech stocks. But it is now a technically discounted price. The company has recently announced a buyback program, which they will be buying back $30 million in stocks. And that means, if you don't know what buyback means, is when a company normally raises capital, they tend to dilute, so issue more shares and dilute. This is the opposite thing. So essentially, they will buy back and consolidate into less share. 30 million is it's not a lot, but is a good start. I just want to say this buyback is not a lot for what the market cap of Zip, which I think is 1.6 billion. I have to check, but it's not much considering the market cap at the moment, but will help to boost investor confidence and at least to somehow hold the stock price around $1, $1.20 in my opinion. That obviously if the market doesn't collapse further. And then the last one, which I'm very interested, but it still appears to be a little bit too expensive, and obviously the most expensive is trading at 100 times earnings, is Polynovo. So, we traded Polynovo many times. There are very strong growth prospects for Polynovo. It's still unclear whether Polynovo will be affected by Trump's tariff. But if it does, I believe it will be around 10%, but they are looking for exemption because it is into a medical sector. So these are the ranking. So Bubs is first in Cettire, then EML, Kogan, Zip, and Polynovo. Obviously, I don't have to say that in terms of growth perspective, the most expensive ones tends to be the ones that the market is pricing for higher growth. So that's the flip side. And the cheapest ones are the safest one now because it's cheap, but the market's not really buying a very aggressive growth opportunity on those companies. So you can diversify entries if you like those stocks based on valuations like that. So if you like this email, so I'm going to be putting the link so you can subscribe just by clicking on the top there once you are reading that email. So now let's take a look the stocks. We'll start with Bubs, which is the first one, the cheapest of them all, and it's going up 6% today. And I don't wonder why, because it is in a sector that are pretty much defensive. They're waiting for the FDA, which is probably 3 to 6 months ahead, to be able to permanently trade in the US. They most likely would be paying like 10% tariff, but that could be easily digested into the price of the product. I mean, added into the price of the product. And honestly, I think the market's not buying this opportunity. Bubs has become net profitable company in this first quarter, in the first half of FY25, and I strongly believe that this is a stock that could double in value. Okay, so this is just my opinion. You gotta make your own research. Do your own due diligence. Now, Cettire is the second cheapest stock, highly shorted. We obviously we took some losses around 95 cents as we had stop loss and we had to sell. Now, obviously, if we buy, we're going to be able to buy the same amount of shares for a much lower value, which means technically we have lost, but also able to buy a lot more shares with the same money. And that's, again, shows the importance of using stop losses. I know that a lot of people don't use stop losses, but this is the key element of our strategy. You gotta use stop loss when the stock breaks from the what we call hypothetical support level there. It tends to fall pretty much the same amount of the level towards the next resistance, and that's exactly what happened here. If you measure that, it's pretty much the same distance, and now we will see a potential bounce right there. This is a heavily shorted stock, and I think we might exhaust short sellers now, and this looks reasonably, not very, but reasonably constructive for me. If today we see strong volume right there. Now let's go to the third one, which is, let me just remind, okay, EML Payments. This is one that has the strongest price, has held really well, only fell about, let me just take a look from the top, only fell about 19%, where Zip, for example, fell 60%. Obviously, I'm not comparing EML with Zip. They are different businesses, but we use similar fundamental metrics to take a look in terms of valuation. So this looks to me, and not just for this, but the whole market, it could be a turning point right there at technically discounted price, not only for the short term but also for the longer term trend. So positive, constructive, and good entry opportunity. Pretty much all the stocks we're talking about are in entry levels right there, but EML has held stronger than most of the other ones that we have just spoken. Now the fourth one is Kogan. Kogan is, again, like domestic stock, is currently trading at multi-year support level, which tends to be a very strong support level. If I go on a weekly chart right there, take a look. So we are at multi-year support level. With COVID crash, it went down to $2.70. Honestly, I don't think we'll go to $2.70 because the business is in much better position, but it has to hold around this type of level right there, and then we're going to be looking for pullbacks, whether that will be a fake breakout or potentially a full breakout. If there is a breakout, then we would be looking at Kogan potentially to try $3 level. That is a possibility depending how crazy the market will go. But technically, Kogan is more tied to RBA cutting rates, which looks like we're going to have another 2 cuts this year, hopefully. If they happen, then that would directly benefit Kogan as well. And then the last one of them, which is the most expensive, and I got my eye here because it's trading at a very critical level, is Polynovo, trading at multi-year support level, around $1 right now. We could have a reversal right here as we speak. Now, is there any indication of reversal? No. The company came up with a report today, which is another positive report. It keeps on issuing positive and record sales, which is extremely positive. But the company came up with the fact that I'm not sure how the tariffs will hit the company. They're actually going to ask for exemption. But if I would be trying to buy Polynovo, I would wait for a pullback right there. See, last 2 days has been positive. Today has been negative. We might have another green candle right there, and potentially the beginning of a consolidation. But the market has to help, right? If US market falls another 5-6% sometime this week, then most likely there's no salvation across the board, right? But for middle to long term, I don't like to put long-term assumptions here in the channel, as most of our trades are completed in 1 to 3 months. But middle to long term, this is a company that I think has very, very strong growth perspective. I just think fundamentally, as the most expensive of them, I would like to see a breakout. And if there is a breakout, I'll buy after the breakout on a potential bounce. Even a fake breakout going towards to 80 cents and bouncing back strongly around 97 cents and $1, that would show a fake breakout and potential bounce on this multi-year resistance level. Great time to look into Polynovo. And let's face, Polynovo went up to $4 some stage, has been trading around $2.60 many times, with a far worse financial position. Now the company is profitable and are able to finance its own expansion without having to raise capital from the market. So that shows solid and sustainable growth to me. Well, that brings us to the end of this video. Let us know what you think. I will wrap up this video now. And let us know what you reckon the market's going to fall further. Could be a bounce right there. Should be buying stocks that appears to be extremely cheap. Should we buy stocks that offer higher growth? What do you reckon? Put in the comments right there. Thank you for watching. I'll see you in the next video.